If you ever noticed your grocery bill, it seemed to have a mind of its own, like constantly reaching for new heights.
Oh, definitely.
It feels like just a little while ago, your money stretched so much further.
Yeah, tell me about it.
Well, in this deep dive, we're going to try and unravel the mystery behind those ever-increasing prices. We're talking inflation.
Mm-hmm.
Our goal today is pretty straightforward.
Yeah.
Just give you a solid grasp of what it is, what kicks it off, and maybe even why a tiny bit of it isn't necessarily the economic boogeyman.
Right. Keep it clear, keep it simple.
Exactly. No super complicated stuff, just the insights you need delivered, clearly and clearly.
Okay, so picture this. Inflation is essentially when the general price level for all sorts of things, like from your morning coffee to your rent, just creeps upwards over time.
Okay.
That means the same $20 bill buys you a little less than it used to. Remember that feeling of, wow, this costs more than I thought?
Yeah, I know that feeling.
That's often inflation doing its thing.
Exactly. It's like my wallet's losing a little bit of its superpower.
Sure.
So what's the culprit then? What makes prices decide to go on this upward journey?
Well, a common driver, as our sources often point out, is often described as too much money chasing too few goods. Imagine everyone suddenly gets a bonus, right? But the number of available gadgets or, say, groceries stays the same.
Right.
What happens next? People are willing to pay more, and so prices tend to rise.
Got it. It's a supply and demand tango, but with way more demand than supply.
Basically, yeah.
Now, I've also heard whispers about central banks and interest rates in this whole equation. How do they play their part?
Ah, right. Central banks sometimes step in to try and manage inflation by tweaking interest rates.
Tweaking them how? Up? Down?
Usually up to fight inflation. The idea is that if borrowing money becomes more expensive because rates are higher, then people and businesses might spend a little less, and that can ease some of that upward pressure on prices.
Interesting. So they're kind of like the economic speed bumps, slow things down a bit?
That's a decent way to think about it, yeah.
Now, here's a curveball for me. I was surprised to learn that a little bit of inflation can actually be seen as a positive sign. How can rising prices be a good thing?
Yeah, it sounds counterintuitive, right? But what's really interesting here is that a small, steady amount of inflation can signal a growing economy.
Huh. How so?
It can nudge people to spend and invest rather than just hoarding cash that's slowly losing a tiny bit of value anyway. It sort of keeps the economic wheels turning.
Okay, that's a fresh perspective. Keeps money moving.
Exactly.
But, okay, when inflation really takes off, like a runaway train,
Yeah.
that definitely hits my bank account hard. That's not good.
Absolutely not. High inflation significantly erodes your purchasing power. Your savings don't stretch as far.
Right.
And affording just everyday necessities can become a real challenge. And that's precisely why understanding inflation and its implications is so crucial for everyone.
Makes total sense. Speaking of our hard-earned money, have you ever considered how it could be quietly working to make more money, even while you're catching some Z's?
Huh. The dream, right.
Totally. That brings us to the intriguing world of compound interest. What's the magic behind that?
Compound interest is basically earning interest not only on your initial investment, your principal, but also on the interest that has already built up.
So interest on interest.
Exactly. Think of it as your money having little helpers that then go on to have their own little helpers. It snowballs.
Whoa, money multiply. I think I've heard Albert Einstein called it the eighth wonder of the world or something.
That's the quote often attributed to him, yeah. And it sounds dramatic, but it really does capture how incredibly powerful it can be.
Can you give me an example, like a simple one?
Sure. Let's say you invest $100 and it earns a 10% return in the first year. After year one, you have $110.
Okay, simple enough.
Now, in the second year, that 10% isn't calculated just on your original $100. It's calculated on the full $110. So you earn $11 in interest that year, bringing your total to $121. That extra dollar compared to the first year, that's the power of earning interest on your interest.
I get it now. It's like that snowball rolling downhill, gathering more and more snow. So the longer it rolls, the bigger it gets.
Precisely. The impact of compound interest grows exponentially over time, which really highlights why starting early, even if it's with smaller amounts, can have such a significant impact on your future financial well-being. Time is your best friend here.
That's definitely food for thought. Start early.
So,
Okay, now while we hope our money is steadily growing like that snowball, I know the market can also experience downturns. The term bear market often pops up. What exactly does that signify?
Right. A bear market is generally characterized by a significant drop in stock prices, usually defined as 20% or more from their recent peak.
20%. Wow.
Yeah, it often reflects a period of investor pessimism and caution about the overall economic outlook. People get nervous.
So it's a signal that the economic weather might be turning a bit stormy.
That's a good analogy, yes. And, it's important to remember that bear markets, while unsettling, are a normal part of the economic cycle.
Normal. Okay.
Historically, periods of decline like this are often followed by periods of recovery and growth eventually. They don't last forever.
That's good to know. So when we hear about a bear market, is it time to just hit the panic button and sell everything?
Well, that's often the emotional reaction, but for long-term investors, bear markets are frequently viewed quite differently. They can be seen as potential opportunities to buy good investments, good companies at lower prices.
Buying when things are on sale, basically.
Kind of, yeah. It's about trying to take a long-term perspective rather than reacting, emotionally to short-term market fluctuations. Easier said than done sometimes, of course.
Sure, I bet. Okay, that provides some much-needed context.
Yeah.
So just to quickly recap what we've dived into, we've explored inflation, those rising prices, often driven by demand outweighing supply.
Right, the too much money chasing too few goods idea.
And how a little bit can actually signal a healthy economy, but too much really hurts.
Definitely erodes that purchasing power.
Then we uncovered the magic of compound interest money growing on itself over time.
Especially when you start early, that time element is key.
Totally. And finally, we navigated bear markets, those significant market drops that are a normal part of the economic journey.
And can even present opportunities for the long haul.
Right. So thinking about how these three things, inflation, compounding, bear markets, all kind of connect. What's maybe one small action you could take today, like right now, to feel a bit more in control, a bit more informed about your own financial world?